Hey friends! Today we're going to explore perpetual futures, also known as perps, one of the most popular tools in the crypto market. You'll learn what they are, how they work, what funding rate and liquidation mean, and how traders make money, both when the market goes up and when it goes down. Let's start with the basics. A traditional futures contract is an agreement to buy or sell an asset at a fixed price at a future date. For example, you agree today to buy Bitcoin 1 month from now at $60,000. When that month is over, the contract settles, and you either make a profit or take a loss depending on the market price. But for crypto traders, waiting a whole month is just too boring. That's why perpetual futures were created. They don't have an expiration date. You can hold your position for as long as you want, a few minutes, a few hours, or several months. You close it whenever you choose, or the system will do it for you if you get liquidated. Now imagine Bitcoin is trading at $100,000. In spot trading, you buy 0.1 BTC for $10,000. Now you own that Bitcoin. You can withdraw it or store it in a wallet. To make a profit, the price must go up. If Bitcoin rises to $110,000, you sell it and make $1,000. So on spot, you can only profit when the price goes up. In futures trading, you don't actually buy Bitcoin. You open a contract that tracks its price. With the same $10,000, you can use 5x leverage and control a position worth $50,000, about 5 BTC. If the price goes up 10%, you make $5,000. But if it drops 10%, you lose $5,000. So with futures, you can make money in both directions, up or down. But the risk is much higher. Now, here's the key question. How does the exchange keep the price of a perpetual futures contract close to the real market price? That's where the funding rate comes in, a mechanism that balances long and short positions. The funding rate is a regular payment between traders holding longs and shorts. If the contract trades above spot price, longs pay shorts. If it trades below spot, shorts pay longs. This encourages the market to self-correct. On most exchanges, funding is paid every 8 hours. So if you hold a position for a long time, these payments can add up and impact your overall profit or loss.
Here's how perpetual futures actually work. You open a long if you believe the price will go up, or a short if you expect it to fall. You deposit a margin, usually in USDT or another stable coin. You can use leverage, like 5x or 10x, to control a larger position. Your profit or loss changes in real time as the price moves. If the price moves too far against you, your position is liquidated. That means the exchange automatically closes your trade to prevent you from losing more than your deposit. Let's look at an example. You open a long position with $1,000 and 10x leverage, giving you control of $10,000 worth of Bitcoin. If the price goes up 1%, you make $100. If it drops 1%, you lose $100. And if it drops more than that, your position gets liquidated. Now let's add the funding rate. If the rate is 0.01% every 8 hours, and you're long on a $10,000 position, you pay $1 every 8 hours. If you hold that position for several days, the cost adds up. It's a small but steady expense. So what exactly is liquidation in futures? Liquidation happens when your losses come close to wiping out your entire margin. Let's say you go long with $1,000 and 10x leverage, controlling $10,000. If the price drops just 10%,
you lose $1,000, your entire deposit. The exchange steps in and closes your trade automatically. That's liquidation. The higher your leverage, the closer your liquidation price. Always use a stop loss to protect yourself and avoid losing everything. Now let's talk about the pros and cons. The advantages of perpetual futures. You can profit when the market goes up or down. There's no expiration date. You decide when to exit. You can use leverage to multiply your potential profits. But the risks are real. High volatility combined with leverage can lead to fast and heavy losses. Poor risk management can get you liquidated, and holding positions for too long can result in funding costs eating into your profits. So to wrap it up, perpetual futures are a powerful tool for active traders, but they require discipline, risk management, and a solid understanding of how funding and leverage work. If you learn to use them correctly, you can trade effectively in both bullish and bearish markets.